Can you really retire safely in Ireland using the 4% rule, or is it way riskier than people think? Because here's the thing, most of the FIRE content you see online, the blogs, the podcasts, the success stories, they're all based on American data, American tax rules, American market returns, and Ireland is not America. The tax system is different, the investment landscape is different, and that changes everything. So in this video, we're breaking down whether the 4% rule actually works in Ireland, what the real risks are, and what you should be doing instead if you're serious about financial independence here. Let's get into it. First, let's make sure we're all on the same page about what the 4% rule actually is. The 4% rule comes from something called the Trinity Study, which was published in the late 1990s. Researchers looked at historical US stock and bond returns going back decades, and they asked one question. If someone retires with a portfolio and withdraws a fixed percentage every year, adjusted for inflation, how long will the money last? They tested different withdrawal rates and different portfolio mixes, and what they found was that a 4% withdrawal rate from a portfolio split between stocks and bonds had about a 95% success rate over 30 years. Meaning in 95 out of 100 historical scenarios, the retiree didn't run out of money. So the idea became this: if you have €1,000,000, you can withdraw €40,000 in year one, then adjust that amount every year for inflation. €41,200 if inflation is 3%, €42,400 the next year, and so on. The theory is your portfolio keeps growing enough to cover those withdrawals over time. That's the 4% rule. It's clean, it's simple, and it's become the foundation of the FIRE movement globally. But here's where it gets messy. The 4% rule is based on US data, US tax rates, US market conditions, and Ireland is structurally different in ways that matter a lot. Let's talk about why Ireland is different and why that impacts safe withdrawal rates. First, tax treatment. In the US, long-term capital gains are taxed at very favorable rates, often 0% to 15% for most people. In Ireland, if you're investing outside a pension, you're paying capital gains tax at 33% on individual stocks, or exit tax at 38% on ETFs, which is even worse. And then there's deemed disposal. Every 8 years, whether you've sold anything or not, revenue treats your ETF holdings as if you've sold them and taxes the gains. You pay tax on money you haven't even withdrawn yet. That is a massive drag on long-term compounding that the Trinity Study didn't account for because it doesn't exist in the US. Second, pension access ages. In Ireland, you generally can't touch your pension until you're at least 50, and even then, only if you've left your employer's scheme. The state pension doesn't kick in until 66, so if you're planning to retire at 40 or 45, you've got a decade or more where you need accessible money outside your pension to bridge that gap. The 4% rule doesn't really address that split. It assumes one big pot you can draw from immediately. In Ireland, you need two pots, one locked in a pension growing tax-free, one accessible for the early years. That changes the math. Third, currency risk. If you're investing in global equities, which most Irish FIRE people are, a lot of your returns are in US dollars or other currencies. The currency exchange rate between the euro and the dollar fluctuates. Sometimes that works in your favor, sometimes it doesn't. Over a 30-year retirement, currency swings can materially impact your real returns in euro terms. The Trinity Study didn't factor that in because it was US investors holding US assets. Fourth, inflation in Ireland. The 4% rule assumes moderate, steady inflation, but Irish inflation can be higher and more volatile than the US, especially in certain periods: housing costs, energy costs, food prices. If Irish inflation runs hot for several years while your portfolio underperforms, your purchasing power erodes faster than the model anticipated.
And finally, market returns. The Trinity Study was based on historical US stock and bond market returns, which have been exceptionally strong over the past century. There's no guarantee global markets will deliver the same returns going forward, and if they don't, if we're in a lower return environment for the next 20 or 30 years, the 4% rule could fail more often than the study suggested. All of these factors add up, and they suggest that the 4% rule, as originally designed, might be too aggressive for Irish investors planning early retirement. Let's run some realistic math for an Irish investor and see what it actually looks like. Say you're planning to retire and you need €40,000 a year to live on. Under the 4% rule, you'd need a portfolio of €1 million. 4% of a million is €40,000. Sounds straightforward. But let's add Irish reality. If a significant portion of that million is in taxable investments outside a pension, you're paying 33 to 38% tax on gains when you sell. So your effective withdrawal isn't €40,000 net, it's closer to €30,000 after tax, depending on how much of your portfolio is gains versus original contributions. That means you actually need a larger portfolio to net €40,000 after tax, maybe €1.2 million or more. Now let's say your annual expenses are €50,000 instead. Under 4%, you'd need €1.25 million. But again, after Irish taxes on your withdrawals, you might need closer to €1.5 million to actually net €50,000 after tax income every year. And that's assuming markets cooperate. If you retire in 2026 and the market drops 40% in 2027 and 2028 while you're pulling out €40,000 a year, your portfolio gets decimated. Even if markets recover later, you've pulled so much out during the downturn that your portfolio never fully recovers. That's how people with €1 million end up broke at 70. Not because they were reckless, because they retired at the wrong time with too aggressive a withdrawal rate.
So, what's a smarter approach for Irish Fire? A few things. First, use 3% to 3.5% as your base withdrawal rate, not 4%. It's more conservative, but it's also more realistic given Irish taxes and longer retirement horizons. Calculate your Fire number based on that. If you need €40,000 a year, aim for 1.14 million to 1.33 million, not 1 million. Second, use flexible withdrawals. Don't rigidly withdraw the same amount every year adjusted for inflation. If the market's down, cut your spending. If it's up, you can spend a bit more or let it compound. Flexibility is one of the most powerful tools you have in early retirement. The 4% rule assumes you're locked into a fixed withdrawal. Real life doesn't work that way. Third, keep a cash buffer. 1 to 2 years of living expenses in cash or very safe assets. If the market crashes, you live off the buffer instead of selling investments at a loss. This smooths out sequence risk and lets your portfolio recover without you panic selling at the bottom. Fourth, blend your pension with taxable investments. Max your pension contributions during your working years. That money grows tax-free and compounds faster. Then use accessible investments, ETFs, savings, to fund the gap between early retirement and pension access at 50 or 60. This two-bucket strategy is how Irish Fire actually works in practice. Fifth, consider part-time income. Barista Fire, cost Fire, whatever you want to call it. If you work part-time or freelance for €10,000 or €15,000 a year, that reduces the pressure on your portfolio significantly. You're not fully retired, but you're also not grinding full-time. You've got freedom and flexibility, and your money lasts much longer. And sixth, if you're flexible about location, geo-arbitrage is an option. Retiring in Portugal, Spain, or another lower cost of living country can stretch your money further. Not everyone wants to leave Ireland, and that's fine, but it's worth considering if your goal is early retirement and your savings are modest. Here's the balanced conclusion. The 4% rule isn't dead. It's a useful starting point. But in Ireland, you need to understand the risks and adjust intelligently. Irish taxes make a real difference. Deemed disposal eats into compounding. Pension access ages complicate early retirement, and longer retirement horizons increase the chance of running out of money. All of these factors suggest that 3% to 3.5% is a smarter, safer withdrawal rate for Irish investors planning to retire early. Does that mean you need to work longer? Maybe. Does it mean you need to save more? Probably. But it also means you're far less likely to run out of money at 75 and have to go back to work. Fire isn't just about quitting your job as fast as possible. It's about building a life where money is never urgent again, and that requires being realistic about the numbers. So do the math for your own situation.
Figure out your actual annual expenses. Factor in Irish taxes. Build in a margin of safety. And don't just assume the 4% rule works here the same way it works in the US. Because it doesn't. Be smarter than that. Be more conservative. And give yourself the best chance of actually staying retired. If this helped you think more clearly about your FIRE number and your withdrawal rate, hit the like button and subscribe. We're covering financial independence, investing and early retirement with an Irish lens every week. Drop a comment and let me know. Are you planning for 4%, 3.5% or something even lower? I'd love to hear where people are at. Thanks for watching. I'll see you in the next one.